Okay, so we are going to do capital budgeting or investment appraisal, whichever way it is. And we are going to talk about payback period, I. Then so A, that's what we're going to work on. Okay.
Yeah.
So first, we have what is called capital budgeting. Another name is investment appraisal. And the concept is that for the business to make projects or to engage in projects or undertake projects, there must be um, options, or business are bound or are prone to make options or are prone to make choices or decisions based on options. Now, we do not make a choice or a decision without alternative courses of action. All right. So capital budgeting is that the business wants to make investments. That's a capital budget. The business wants to make an investment into a capital asset or into a capital investment. And the capital budgeting talks about the tools we need as a business to determine which of the investments the business intends investing into, right, will be feasible, will be more profitable, will bring more profit to the organization, will cause the business to be a going concern in accounting, or will cause the business to be able to generate more income rather than running at losses. So that's basically what capital budgeting is about. So it's borders on decision making with respect to um, the interests of the organization in where to invest its money. So there could be alternative course of action about two or three, and capital budgeting tools or methods will be used to analyze which of these three the business should invest in based on returns on each of them. Are we okay?
Yeah.
Right. So we have methods used under this capital budgeting. They are called cash flow methods. We have this non-discounted cash flow method. We have the cash flow methods. We have the discounted cash flow methods. With the non-discounted cash flow methods, it means that now examples, what these non-discounted cash flow methods, they are more of like um, they don't make use of the discount factor or discounting factor. They don't make use of it. But this one makes use of the discount factor. The discounted cash flow method. What's the discount factor? The discount factor is basically used to reduce the value or reduce a future value to a present value. Its main work, its main function is to reduce a future value to a present value. So, for example, the formula for future value equals present value over 1 plus r exponent n. That's the formula of the future value. Now, the future value is saying that assuming the business you want to have 500 cedis in future in 2 years' time. How much should you invest now? So let me write it. A Kofi, let me use Uche.
Mm.
Uche expects, will you keep quiet? And 500 cities in the future, or 500 cities in 3 years' time. Would you expect to earn 500 cities in 3 years' time at a rate of let's say 5%? How much should he invest now? So, would you expect to earn 500 cities in 3 years' time at a rate of 5%? How much should he invest now? Now, what we will say is that the figure of 500 cities, when does Uche expect to earn 500 cities?
3 years now.
Is it future or present value?
What's in the future?
So the 500 is future value. So the formula I've written there, which is the fair value, future value equals PV to bracket 1 plus R exponent N. The 500 is the future value. The 5% is the rate. Sometimes they can use I to represent it. The N is the 3 years. The N is the 3 years. So 500 will replace the future value equals, we are searching for the present value, then 1 plus R. R is the 5%. So the 5% is now 0.05, and the N is 3 years. Are you good?
Yeah.
So let me make PV the subject. So it should be PV times 1 plus 0.05 all over 1 plus 0.05. Are you getting it?
Yeah.
So we have that, we'll cancel that. So I'll be left is, so what do 500 over 1 plus 0.05 exponent 3 give us?
I'm on notes. That'll give us 431.918.
431.91. That's the present value. So watch. The present value figure and the future value figure, which is, hey, why? Well, did you do the right thing?
What?
You shouldn't get that figure. You shouldn't get that figure. You said forward.
31.9187993.
All right, so 92. Let's make it 92. So PV equals what? 431.92. I get it.
Yeah.
All right. Now, so look at the PV and the FV. Which one is greater?
The PV and the FV is greater.
So what we mean is that, so I've gotten this solution, right? So it means the
Yeah.
business of Uche must invest 431.92 now to earn 500 cedis in future at a rate of 5% for 3 years. So what's made the 500 become 1431.92? It is called the discount factor. So another way I can solve this is I would say PV equals FV times 1 plus R exponent negative n. What is my FV? 500. 1 plus, what is my R? 0.05. What is my N? 3. Now compute this 500 multiplied by bracket into bracket 1 plus 0.05 exponent 3. Compute all on the calculator. What do you have?
Isn't it -3? But you didn't add a negative.
Yeah, thanks. What do you have?
Now give us 431.9187. So
That's 9.
431.92.
So you could see what cost this 500 to become 43192. What caused it? What can you say? It is this. Are you getting it?
Yeah.
So another way of writing the 1 plus 0.05 exponent -3, it is this way.
Okay.
Divided by. So the 500 is the numerator. This is the 500 here. And then divided by 1 plus 0.05 exponent 3. So if I want to bring the 1 plus 0.05 exponent 3, which is the denominator here, which is the denominator to multiply the 500 in the numerator, I will say 500 times the 1 plus 0.05. Then let's say the over will become negative, and the 3. Do you get it?
Yeah.
It is called the inverse form. The inverse form. The inverse form. So what I want to say is that what enabled the 500 to now become 431.92 is as a result of the discount factor. This word. What we are talking about. This discount factor. So that is called this. So what is the formula for discount factor? Discount factor is 1 plus R exponent negative n. Are you getting it?
Yeah.
And we have compounding factor or compound factor. The compounding factor or compound factor is
This
1
a
plus R.
negative n or positive n. And
The
discount.
discount factor is exponent negative n. Compounding factor is exponent n.
Oh, okay.
So in the future value formula, you see PV, the one at the top, the first one, FV equals PV 1 plus into bracket 1 plus R bracket close exponent n. That is a compound factor. When the n is positive, it's compound factor. When the n is negative, it is discount factor.
Okay.
Do you get it?
Yeah.
All right. So I'm trying to say here is that, here, I'm back to this. The cash flow methods, we have the non-discounted cash flow and we have the discounted cash flow methods. Non-discounted cash flow method means the cash flows, which are like future values, we don't use the discount factor for them. And the discounted cash flow methods says that the which are like future values, we discount them by using the discount factor. Do you get it?
Yeah.
So we have the cash flow methods under capital budgeting to be the non-discounted means without discounts. All right. So what are some examples of the non-discounted cash flow methods? We have payback period. We have ROS. We have ARR. The discounted cash flow methods. We have this payback period. It's not discounted. The discounted one is called discounted PBP, payback period. Then we have the NPV. Then we have IRR. We have PI, profitability index. Are we good?
Yeah.
So when you see, you should bear in mind the high three. There are other methods, but we have MIRR, we have Macaulay duration. Those are for other corporate finances, are into corporate finance. So payback period. So know that the non-discounted cash flow method, whenever you see payback period, it is non-discounted. Non-discounted means it doesn't make use of the discount factor, which is 1 plus R exponent negative N. That's the discount or discounting factor. And I said the discount factor's role is to reduce a future value figure or a figure in the future or a cash flow to the present. So when I say I'm going to discount, it means the future, the value is into the future, the money figure is into the future. When I bring it down, it is a present value. I get it. So in other words, when I say I'm going to count a figure, it means I'm bringing a future figure to the present. I'm bringing it to the present. Therefore, the present value figure will be less than the future value figure because the future value figure must be bigger. Do you understand it?
Yeah.
So that's the payback period. Then we have the ROS, the ARR. So whenever you had non-discounted cash flow method, you see payback period, ROS, and ARR. It means that these three don't use discount factor. But on the other hand, those on the right, discounted payback period. So you can hear from the discounted payback period. So it means that the payback period, which is on the left-hand side, is being discounted. That's why you're having it on the right-hand side. Net present value. Immediately you hear present value, it means you're going to use discount factor. Present value. Immediately you hear present value, it means you're going to use discount factor. IRR, internal rate of return. That one too, we will use the NPV. So that is why it is discounted cash flow method. Then we have the profitability index, PI. PI also will use NPV. That is why they are all under the discounted cash flow methods. Are we good?
Yeah.
Amazing. Hold on. My phone's the message is plenty. All right. So we are going to solve a full question. It's not difficult. Pay attention, and you'll be able to do it. All right. So read. Let's start reading. Mm-hmm.
Hold on. The accountant of your company has recently been taken ill through work stress. In his absence, his assistant has prepared some calculation of mutually exclusive investment projects. Both projects are concerned with the purchase of new plants. The following data is available for each project. Cost of plants, plant one, plant two, expected annual profit. Hey, how should I even read this? Okay. The
No,
company
no, I
has
don't mention it.
estimated cost
No.
of capital of 10% and employ the straight line method of depreciation for all fixed assets. Neither project would increase the working capital of the company. The company has sufficient funds to meet all capital expenditure requirements required. For each of the plans, calculate the comments on your findings about the proposed investment. The payback period. Discounted payback period. The net present value. The internal rate of return. The profitability index, and then VIROCE. Yeah. B, states which, if any, of the two investment projects your company directors should accept and why. From your answer B above, discuss the reason why the NPV method of investment appraisal should be preferred to other IRR. End of question.
That's great. So let's start. Now, let's do some quick recap. Payback period. Is it a discounted cash flow method or is it a non-discounted cash flow method?
It's non-discounted.
Why?
You don't have to pay there's no discounts attached. Don't know how to explain.
Because what?
There's no discount attached to something here.
Because it doesn't make use of discount factor.
Um,
Are you good?
yeah.
It doesn't make use of discount factor. What about the second one?
Discounted. Yeah, it is a discounted method.
Third one.
Um, Discounted method.
Why?
It makes use of this discount factor method.
Why? Why?
Yeah, it makes use of the discount factor method.
Yeah, how do you know that?
From what you said previously, it was under the discounted.
Yeah, but I explain why.
No, you didn't explain
Okay,
why.
okay, I hear. I said whenever you hear PV,
Yeah.
present value, it means it's going to make use of the discount factor. Because present value means you are bringing a future value to the present. You are bringing a future value to now, to current. So to find the current, you have to multiply it by the discount factor. It's the discount factor which will pull the figure from the future to make it present. And definitely, the present value is always more than the future value if it's an investment. Are you good?
Yeah.
That's the interpretation. So whenever you hear present value in capital budgeting, it means that, or investments, it means that it's making use of a discount factor. Capital budgeting is making use of a discount factor. Internal rate of return also make use of the PV because of the present value in it. The net present value in it, it makes use of the discount factor. Profitability index also make use of it. ROAS is not. ROAS is not a discounted cash flow method. It is a non-discounted because it doesn't make use of the discount factor. Are we good?
Yeah.
So now, let me explain this very question here. There are some elements we need to think of. One, mostly we can have cash flows and we'll just go on and prepare the payback, discounted payback. But in this case, the figures we are having, they are not cash flows. It says they are what? Expected annual profits. So year one, these are in years. This year one, year two, year three. So they want to purchase two plants, basically. One is costing 100,000, one is costing 60,000. And they expected that if they are to purchase a plant of 100,000, the profits anticipated to derive from the plant one for year one is 29,000. That's the annual profits. Year two, they'll make a loss of 1,000. Year three, they would earn another profit of 2,000. Then in that same year three, they will sell it for 7,000. Residual value, meaning they'll sell it for 7,000. The same or the similar events is for the plant two, which they will purchase at 60,000. So you could see cost of plants here. 60,000 for plant two, 100,000 for plant one. Then plant two is 18,000. Plant two is 2,000. Plant three is 4,000 profits. And the estimated residual value is what? 2,000, 6,000. Meaning at the end of the 3 years, they will dispose of, they will sell away, they would sell the plant to scraps or for scraps to the tune of 6,000 Ghana cedis, which is plant two. Are you following?
Yeah.
So because it says these are annual profits, we need to make some adjustments to the profit figure. The question never said these are the annual cash flows. If there are cash flows, it's different, but it said these are annual profits. So we need to find cash flows. We don't need profits to compute this question. But here they gave us profits. We need cash flows, not profits. Are we okay?
Yeah.
So pay attention. Another area. The company has an estimated cost of capital of 10% and employs the straight line method of depreciation. So the company employs what? Straight line method of depreciation. They mentioned, if the question ever mentioned depreciation, there are two ways. Assuming that this question we're going to solve, it never mentioned anything like depreciation. If it never mentioned anything like depreciation, the first point is we will not solve depreciation. Let's say in such cases or in some cases, let me put it this way, when they are cash flows, straight cash flows, the business doesn't, or the question will never make mention of depreciation. It will rather make mention of depreciation when it's about profits, annual profits, annual profit. When the business makes mention of annual profits, it will go in line with depreciation. So in some questions, they could, like here, it's explicitly stated that there should be depreciation because of annual profits. Some questions also, the business will not make mention of annual depreciation, though it's annual profits, but it will give you the estimated residual value. So though the question may not make mention of depreciation, but the cash flows are, or there are annual profits estimated for each year, and the question gives estimated residual value, we will know that because of the residual value, and also because it's an annual profit, and because it's under capital budgeting, we have to go and find depreciation, calculate for depreciation. Do you understand it?
Yeah.
So here in this question, 1 is an annual profit. 2, there's an estimated value. 3 is it has mentioned depreciation. So it means we have to go and calculate for depreciation for each of the plants. Are you good?
Yeah.
So assuming the question gave annual profits, gave estimated residual value, never mentioned anything on depreciation. So long as we have annual profits, we have estimated residual value, we can go and calculate for depreciation. Regardless it mentioned it or it never mentioned it. Are we okay?
Yeah.
So the first thing we have to do to solve this is we have to find the cash flows. So the company has an estimated cost of capital of 10% and employs the Australian method of depreciation for all fixed assets, all fixed assets, implying that or inferring that the plant 1 and plant 2 are all fixed assets. So if plant 1 and plant 2 are equipment and they are or they fall under PPE, property, plant and equipment, and they're also tangible and long-term assets, or they're also fixed assets, then it means the depreciation is applicable to plant 1 at the same time plant 2. In other words, we have to find depreciation on plant 1, depreciation on plant 2. Are we okay?
Yeah.
So this is what we are going to do. I'll be doing 1, you do 1. I'll do 1, you do 1. Okay?
Okay.
Neither project would increase the working capital of the company. The company has sufficient funds to meet all capital expenditure requirements required for each of the plants. Okay. So what I said in essence was that here the question has given us an information, and this information relates to annual profits, estimated residual value, depreciation. But then we need to find a cash flow. We are not using annual profits. We need to find a cash flow. So for us to find a cash flow, what do? We will have to add the plant. Sorry, we have to add the profits on each plant to the depreciation. Why? If the question has given us, the annual profits, and we want to find cash flow, what it means is that let's make profit the subject in this equation. It means what? It was a cash flow minus what? Depreciation equals what? The profit. Do you get it?
Yeah.
It means that the profits are for plant 1 and plant 2. Okay, tell me what you think. From what I've just explained, what do you think is happening to the profit of plant 1 and 2? If you want to find a cash flow, what do you think, or what do you think is the issue with the profits there? How did they arrive at the profits there? The plant 1 and plant 2 profits, annual profits. How did they arrive at them?
So
Mm-hmm.
minus
What?
minus one
Minus
minus
what?
mm, the top
It
one
means that,
minus the down one.
okay,
Okay.
it means that there was a cash flow. They took out depreciation and got the profits. The profit you are seeing there. Are we okay?
Yeah.
There was a cash flow. They took out depreciation and then they got the profits. So if we want to find a cash flow, what do we do from here? What do we do? If we want to make cash flow the subject, what do we have?
Profits
Mhm.
plus depreciation.
That's what we have at the top. Do you
Yeah.
get it?
Yeah.
So we need the cash flow. The cash flow is what we are needing. We need the cash flows are the future values we need. But they rather give us the profits. We don't need the profits. We need the cash flows. So how do we get our cash flows back? I mean, the profits they've given us, we have to add depreciation to it. Then we'll get the cash flow. Then we can use the cash flow to solve the question which they or the requirements which they have stated there. Do you get it?
Yeah.
We have a cash flow. We need to use cash flows because the what we are learning is that future value is equal to what? Present value times 1 plus r exponent n. When you are solving for future value, the n is positive. When the present value becomes the subject, the n becomes negative, multiplied by the future value. So here we need the future values are the cash flows. But these people have taken something out of it, which is the depreciation. And now we have the profits. We don't need the profits. We need the cash flows, which are the future values. So what do we then have to do? Just add back the depreciation you took out to arrive at the profits. Add that depreciation back to the profits. And let's have the cash flow. Are we good?
Mm-hmm.
Are we good?
Yeah.
So I'm doing for plant one, you do for plant two. So plant one. So cash flow. Before you start solving for the cash flow, you must first find. Now we have the profits there. We have the profits figures there. Then we have depreciation. Now we know the profits. We don't know the depreciation. So you have to go and find the depreciation and then add it back to the profits for each year to find the cash flow for each year. Are you good? So what I'm
Yeah.
trying to say is this. We have the profits. We have year one, year two, year three. So year one, the profit for year one for plant one is 29,000. Then to year two, it made a loss, 1,000. Then year three, we had 2,000. Are you good?
Yeah.
Then we have to add the depreciation. Then that will give us the cash flow. So assuming the depreciation is 5,000 each year, because depreciation, you are using straight line. Straight line means it's per year. It means what's going to be our cash flow. 29 plus 5 is what? 34,000.
Away
Negative
from the
1,000 plus,
5,000 in the question. Or you assume the depreciation.
I'm assuming now. So what I mean
Oh.
is we are here to go and compete for the depreciation. But I'm telling you how it's going to look like, how the
Um,
overview of it, right? So when we get the depreciation, it will be for each year. We will come and add the depreciation to the profits per year. So we'll say 29,000. These are the profits figures I took from the question. Depreciation is an assumed or a supposed depreciation figure or an assumption. So 29,000 plus 5,000 give us 34,000. Negative 1,000 plus 5,000 give us 4,000.
why is the negative?
2,000 plus
Okay.
loss. If it's in the bracket, it's a loss.
The loss. Oh, okay.
2,000 year three. 2,000 plus 5,000 is what?
So
8,000.
7.
Are you
It's
good?
7.
So have you seen how we got a cash flow?
How did you get a 8,000? Is it plus?
Ah, yeah, 7,000, 7,000. I miscalculated it. So 7,000, right?
Yeah.
So 7,000. 7,000. Are you good?
Yeah.
Okay. So that's how we'll get the cash flows. This is what we need to solve the questions there. We need a cash flow. But they rather gave us the profits. They didn't give us the depreciation. So we will have to go and search for the depreciation, then add it to each year of the profits. Then we get the cash flow. Then from the cash flow, we can continue solving the requirements or meeting the demands of the requirements. Do you understand it now?
Yeah.
So let me see whether you get it. So before we start working, what do you think we need? We need what do we need to start working?
Hmm?
Before we start
You need
solving the
to
requirement.
you need to find your depreciation.
Why do you need a depreciation? Why do you need a depreciation?
Because the question asks, the
No, no,
question,
no, no,
the
no.
question,
Yeah, I know it's in the question, but why do you need a depreciation?
you need to find your depreciation before you can add it to before you can solve the question.
Yeah, so when you get a depreciation, what do you do to it? That's what I mean.
You add it to every year.
Every year, what?
Yeah. Every year.
Every
So the plants one every year, like
every year,
year
every year,
one, year
what?
two.
Every year, what? I want the name.
Profits.
Annual profit. Every year profits, right?
Yeah.
You get what? When you add a depreciation to the profit, what do you get? What do you arrive at?
Cash flow.
Good. So we need a cash flow to because we can solve the question. But the question didn't give us the cash flow. It rather gave us the profits and then gave us leads, gave us elements to be able to compute for the depreciation. Then when you get a depreciation for each year, we will then come and add it to the profits for each year before we get the cash flow. So upon arriving at the cash flow or obtain the cash flow, we can then start working. But we need a cash flow to work. We don't need the profits.
Mm.
Are we good?
Yeah.
So that's how it doesn't mean all questions are like this. There are some questions where the cash flow will be given straight away in the question. So what you have to do is just you continue working. You don't go and find depreciation, profit, nothing. You just proceed to work. And I've told you some of the leads to determining or detecting whether or not a depreciation should be calculated. One, the question will make would indicate the profits, annual profits. Two, it would also indicate the estimated value. It's estimated residual value. Residual value. The residual value is also known as the scrap value. Okay. Yeah, that's another name for it. Residual value, scrap value. So it can also estimate the residual value. So I could say there was no residual value. But here in this question, there are residual values for plant one and plant two. So those are leads to tell you that you have to compute the depreciation. Are you getting it?
Yeah.
Okay. Okay. That's fine. So now, plant one. What do we do for plant one? So the first thing is we have to find the depreciation. So plant one, depreciation. It says straight line method. Straight line method of depreciation is the costs minus the um, scrap value. Here in this question, they said residual value. So residual value all over the useful life or estimated useful life. That is a formula for depreciation, straight line method. So when you hear straight line method, this is how it should be. Cost minus residual value over estimated useful life or over useful life. Then we go on depreciation. So I'm computing it for plant one. Equals what is the cost for plant one?
29,000.
Look at the data well and tell me the cost of the plant one.
800,000.
Leave my class. Next time, give me any wrong answer. You leave the class. Minus what's the residual value for plant one?
7,000.
Residual value means the amount at which the business will sell the asset after it has exhausted or after it has consumed its useful life. So the useful life is 3 years, meaning after 3 years, the business would part with the asset. The business will dispose it of. The business would give out the asset. The business will sell the plant as scrap to the scrap dealers. Let me put it that way. So how many years are for plant one?
Mm,
3 years. You see year 1 year, 2 year, 3. So 3 years.
Oh, okay.
Complete on your calculator.
Okay. $31,000.
So it is 31,000 cedis per year.
Okay.
31,000 cedis per year. Are you getting it?
Yeah.
Yeah. So it means that this 31,000 per year is called depreciation charge. Depreciation charge
Okay.
is an expense. I believe you are writing.
Yeah, but if I write, I can't support it. So I'm writing some.
Right. Tell me you are writing and I'll pause. Don't tell me you are listening.
Oh, okay.
How can you be listening to calculate this, all these explanations and writing? You are telling me you are listening.
So
How can
I'm
you be listening to
writing.
calculation? So you tell me I'm writing and I'll pause. After you finish, we continue.
All right.
Okay. I'm listening. You are computational work. Even me, I cannot be listening to computation and remember everything. I never knew your mind was like
Oh,
had
no,
a hundred
I learn
gigabyte.
if I don't if I'm writing, I can't focus. That's how.
So when I'm done, then you tell me you want to
Uh-huh.
write. So you have to
Understand.
tell me that.
I'm done writing.
All right. So that's it. So depreciation charge is for 31,000 per year for plant one. So solve plant two, depreciation charge for plant two, solve it.
So is that how we're supposed to do it? You're supposed to solve everything for plants one before you, or you mix it.
Solve the plant two depreciation charge and tell me your answer.
I got 18,000.
Let me see whether you are telling lies. How do you do it?
Um, 60,000 minus 6,000
Where
over
do you get the 60,000 from?
from the plant two.
Is the cost, right?
Yeah.
What's the residual value? 6,000. Divided by 3 years. So 60 minus 6,000 is 54,000. So 313. Then you have 24, 3, 24. So 18,000 per year, is correct? Are you good?
Yeah.
Done. So now we've gotten a depreciation for each of the plants. We need a cash flow. And what we are understanding is that the depreciation was taken out from the plants, from the cash flow for the business to arrive at the profits. So we need to add back the depreciation to the profits to get the cash flow. And from the cash flow, we can solve what we have seen there. We good?
Yeah.
So I'm doing for plant one. So cash flow for plant one. So we have the year 1. Then put year 0, year 1, year 2, year 3. Then we have the profits. Year 0, no profits. Year 1, 29,000. Year 2, 1,000. Year 3, 2,000. Then we have the depreciation charge we are going to add. For plant 1, year 0, no depreciation. Plant year 0, no depreciation. Year 1, plant 1, what is the depreciation charge per year for plant 1?
31,000.
So when we add the profit to the depreciation, what do we have? What do we arrive at?
29.
When we add the profits to the depreciation, what do we arrive at?
Yeah, I'm calculating it.
No, I'm not asking you for the figures. I'm saying when we add the profit to the depreciation, what do we arrive at? The cash flow.
Um,
Cash flow. Cash flow.
oh, okay.
I'm not really mentioning figure. I just said when you add the profit
Uh,
to the depreciation, we get the cash flow. So now year 1, year 0. By here,
0.
the cash flow, hold on. Cash flow for year 0 is the cost. What is the cost of year plant 1? 100,000.
100. Oh, okay.
So that's the cash flow. Then year 1, what is the cash flow? So you add the profit to the depreciation.
60,000.
Year 2,
This how do you do it? 31,000 minus 1,000, right?
you add, yeah.
Eh?
Yes.
So 30,000.
Year 3,
Or is that 31,000? That's 3.
pay attention. By the same year 3, there's another cash flow. The cash flow is 7,000. This so year 3, because in year 3, they will make a profit of 2,000. They took the depreciation of 31,000. It is in year 3 that they will sell or dispose of or part away with the plant 1. Because they finish using it, they only want to use it for 3 years. After 3 years, they would say we are selling it for scraps for 7,000. I hope you get it.
Yeah.
Do you get it?
Yeah.
Good. So in year 3,
So it should
the
be 4
7,000,
years.
listen to me. In year 3, they will use the plant till year 3. So at the end of year 3, they were going to make or earn a profit of 2,000. But when they earn a profit of 2,000 at the end of year 3, they will sell the assets. And at the end of that same year 3, let's say 31st December, they will sell the assets. So by the time year 4 will be due, the asset is no more there in the organization. They've sold it off. How much will they sell it off for? They will sell it off for
7,000.
7,000 Ghana cedi. That's called consideration. That is called that is a revenue. That's an other income.
Oh, there's so many
I get
things
me.
to this thing.
They are what?
There's so many, I don't know how to explain it, but it's just plenty.
What is plenty?
The whole thing. So you said the question said 3 years, but okay, I understand. Like, let me
You
see.
you have you have a Mercedes Benz, the one you crashed, the one you crashed. So
Mhm.
you crashed. Let's say the person bought the Mercedes Benz for, let's say you crashed it last year December. So the
Yeah,
person bought the Mercedes Benz. Last year was 2025. The person bought the Mercedes Benz somewhere in 20 this 20, so let's say 2020, 22,000. No, 2020. So from year 1, you said that when I buy this Mercedes Benz, year 1, this is a profit I'm going to have. But you've calculated depreciation and taken out from the profit. You've taken the depreciation out of the cash flow. So you now have the profit. Year one, I'll get this profit. Year two, year three, year four, year five. Then at the end of year five, someone crashed your car, the Mercedes. Someone crashed your vehicle. Then say, oh, because someone has crashed my vehicle, though I'll
I'll
use
be
it for in
selling.
year five. Hold on.
Mhm.
Though I'll use it in year five, at the end of the year, that's in December, I will sell it off. So you bought this for 100,000. At the end of the fifth year, at the end of you bought it for 100,000 in 2020. So by the time of 2025, where your vehicle got an accident, then in December 31st, you said, okay, I've used this vehicle for this fifth year, 2025. Let me sell it off. Then you sold the vehicle which you bought for 100,000 at the end of year five for 7,000. So did you use it in 2026?
No,
So in which year did you sell the vehicle?
2025.
In that same 2025, did you also make profit on the vehicle before you sold it?
No.
Yeah, you made a profit. I'm saying the assumption is that you make a profit in that year before you
Mm,
sell it. So you made a profit in that year, 2025. You make a profit on the vehicle in 2020 when you bought it, 2021, 2022, 2023, 2024. Then in 2025, so you make a profit. Then your vehicle got an accident. So that vehicle which got an accident, you then say that at the end of the year, 31st December, I'll sell this vehicle because it has encountered or experienced an accident. So I'm going to sell it off. So in that same 2025, you use the vehicle, you made profit out of it. Let's say your vehicle, you use your vehicle to for what is called chauffeur. Chauffeur are personal drivers, people who would contact a car rental, and the car rentals will bring their vehicles, or the car rental will bring the vehicle plus a driver to drive the person to wherever he wants to go to. I get it.
yeah.
So in the fifth year, you use it for that same chauffeur business. But then, because it got an accident at the end of the year, 31st December, you sold it off. So the profit you made, the cash flow, the money which came to you in that 2025 can be added to the amount you also sold the assets for, all in 2025. So in 2025, you have two earnings: earnings from the regular operations and earnings from the sale of the vehicle in the same year. Do you understand it?
Yes.
So in year three, how much will plant one bring to the business? What will be the cash flow for plant one in year three, the total cash flow?
60.
In year
Year one.
three, look,
Year three.
I'm saying,
33.
how much will be the total cash flow plant one will bring to
7.
the business? What?
7,000. 7,000.
How much will, listen to me, how much will be the total cash flow?
So you add from year one to year three.
In year three, how much will be the total cash flow in year three?
Oh, 33 plus. Then,
Uh,
oh,
because they are making a cash, they are going to have a profit and value the depreciation. So that's the first cash flow. And they will sell it again. They will have another cash flow. So those two give you for so only year three, the business would accumulate 40,000 in cash flows. Do you understand it?
yeah.
So that 7,000 there in the question is not part of the profits because they will earn it after the sale or disposal or parting away with the plant one. Are you
Okay.
okay?
Yeah. Okay. So,
Are you okay?
yeah, I'm writing.
When you finish, solve plant two.
Oh, okay.
Are you done?
I'm done writing. Now coming to solve the question.
Yeah, be quick. Solve for plan 2.
Um, Okay. Can't see the question. Yeah.
Yeah, what do you have?
I'm almost done.
Okay, continue.
Okay.
So I'm
Yeah,
going to solve it
so
quickly.
okay.
So plan 2, cash flow. So I'm going to have year 0, 1, 2, 3. Then profits, I have 18 years dash. Loss of 2,000, 4,000. Then I have the depreciation. What does the depreciation charge?
18,000 for year 2, plan 2.
So year 0 dash 18,000, 18,000, 18,000. Then I have the cash flow. The cost of the asset is 60,000.
1,000.
Then we
That
have
is
36,000.
16,000. 22,000.
Then we'll bring the estimated residual
That's
value of 6,000, year 3. So this together gives us 28,000.
8,000.
Now, in terms of the cash flow, we have what is called inflow and we have outflow. When money flows into the business, when money flows into the business, it increases the cash flow. So inflow figures are always positive. When money flows out of the business, it decreases the cash flow. So therefore, outflow figures are always negative. So the cash flow we have 60, 36, 16, 22, 6,000. The 36, 16, 22, and 6,000, they are all flowing into the business. So they are inflows. They will be positive. The 60,000 is the cost of the plant. If the business wants to go and purchase the plant, they will spend 60,000 So that 60,000 is money flowing in or flowing out of the business.
It's flowing out.
So we make it negative. You good?
Yeah.
The same happens to CV for plant one. It's an outflow.
Mm,
Are we good?
yeah.
Okay. So that's it. I believe you've written it down.
Yes.
So now we said that we can only find a payback period per the capital budgeting rules when we've we have the cash flow, not when we have the profits. So now that we've gotten the cash flow for plant one and plant two, we can now solve for the payback period. So I'll solve for the payback period for plant one, then you solve for plant two. Then we will tell what we have. Are you good?
Yeah.
So we are now going to solve for the a question. We are now going to attempt the question. One, payback period. What is payback period? Payback period simply means how long, period. How long, period. So let me use PBP.
To
How
get you
long,
to
period,
pay.
the business will take to pay back or to recoup or to get back the 60,000 it's invested,
Mm,
right? So I'm using for plant one. So I'm doing payback period for plant one. So I write the years, year zero, year one, year two, year three.
three.
Then I write the cash flow, not the profits. So what are the cash flows for plant one? Here. What are the cash flows for plant one?
60,000.
Year zero is part
So 100,000.
negative, 100,000 negative. Then year one is what?
60,000.
60, 30, 40. So 60, 30, 40,
33. Oh, okay.
40, 40.
Mhm.
Hmm? Then
Yeah.
I'll bring payback period. There are several recommendations to how you can find a payback period, but there's one method. Let's use this method, which is also correct. Now, here, the business, let's say the business owes 100,000, which is negative, which is an outflow. That's the money the business is going to pay. And year one, the cash flow into the business is 60,000. On my calculator, I'll compute it this way. Negative 100,000, because the 100,000 is in a bracket or jacket, so it's negative. Negative 100,000 plus the 60,000, because the 60,000 is positive, 100,000 is negative. The 60,000 is an inflow. That's why money is flowing in. It's positive. 100,000 is an outflow, is flowing out, therefore it's negative. Are you good?
Yeah.
What do you have?
Negative 40,000.
So negative 40,000. Negative. So I'll put it in a bracket. It's an outflow. Good.
Yeah.
What's next?
Yeah, two.
Hey, have I sent you that question?
No.
Mm-hmm. Year two.
I have that. I think it's in the book the woman sold it to us.
I don't think. The figures may
It's,
not be the same. This was an assignment given to. It may,
yeah.
the similar figures may be, but not the same figures.
Oh, okay.
So what's in year two? What do you have for year two? So year two, you subtract. You subtract You subtract, what was the name? Let me forward it to you. Or let it be here. I'll forward it to you when we're done.
Mm.
Year 2, we can use other methods such as to have the year 2. So year 2, we say we can say 100,000, negative 100,000
You've not
plus
sent
60.
me the question.
Yeah, I'll send them to you. I'll send it to you.
Oh,
We
okay.
watch year 2, we can say to find year 2 payback balance. In other words, what we are writing at the payback here is more of like a balance. So year 2, we can say negative 100 plus 60 plus 30. What do we have? So I'm going vertically.
Negative.
Vertically. Negative 100 plus 60 plus 30. What do we have?
Mhm.
Quick, quick,
So
quick.
negative 100 plus 60 plus 30.
Did you see why I
7,000.
picked the figures?
70,000.
Negative 100 plus 60 plus 30. Did you see how I picked the figures?
Yeah, from the top down.
Okay.
70,000.
Mhm. It's wrong. It's wrong.
Seven.
It's wrong.
Oh, negative 1,000, 100,000.
Use go for a better calculator so that we don't have
No,
to
I'm using
spend
my
time.
mind. But negative 100,000
Uh,
plus
use a
60
calculator.
gave us 40,000.
Use the calculator. Don't be using your mind.
Okay. Negative
Hey,
100,000 plus 60 plus 30. Oh, okay. Negative 10,000.
don't use your mind. Just use the calculator. So we can go that way. Negative 100 plus 60 plus 30. Or we can say this. Year 1, we got 60,000. We paid a portion of our 100,000 we are owing. The balance became 40,000. So we are still owing, right?
Yeah.
Then in year 2, we will earn 30,000. This 30,000, we already have a balance in year 1, which is 40,000. So our 30,000 we will earn in year 2. We would go and pay the outstanding balance on our loan. Let's say 40,000, right?
Mm-hmm.
So we owe 40,000 at the end of year 1 after having paid 60,000 of our standing 100,000 debt. Let's say the business will borrow 100,000 for to go and purchase plant 1. So when they borrowed the 100,000, they said year 1 we'll get 60,000. So we'll go and pay a portion or part of the 100,000. We have 40,000 negative. Then year 2, 30,000. We'll pay 40,000. The 40,000 we are having, we'll pay 30,000, right?
Yeah.
What will be the difference? 10,000 negative, right?
Yeah.
Good. So we can also go by that method. Or you can say negative 100 plus 60 plus 30. What you see, 100 is negative. Just compute it on a calculator. 60 is positive, 30 is positive. Are you good?
Yeah.
Okay. Now let's go on. How do you find the last? Now, the last, you can see that the year 2, we had 40,000 outstanding or 40,000 balance in year 1, which we were owing, right?
Yes.
But because the 30,000 was less than the 40,000, we had to use the 30,000 to go and pay the 40,000, and we have 10,000 remaining, right?
Yeah.
So it means in year 3, the business can pay all the 10,000 it's owing, or the outstanding 10,000 balance, right?
Mm-hmm. Yeah.
Have you seen it?
Yes.
In year 2, the business can pay all the 10. In year 3, the business will earn 4,000 in cash flow or in revenue, and it will pay the outstanding 10,000 balance at the end of year 2, right?
Yeah.
So because the year 3 cash flow of 40,000, is more than the outstanding 10,000 at the end of year 2, we will pick the 10,000 which is outstanding in positive terms, absolute terms, and divide it by the 40,000 for the year 3 and multiply it by 12 months. We basically want to know how many months in year 3 will it take the business to pay off the 10,000. Are we good?
Yeah.
So calculate it and tell me don't use your head. Use the
So
calculator.
so in year 1, if it was 40,000 and then year 2, the cash flow was 20,000, is that the same thing you do? Like 40,000 times 12 months over 2,000.
If I don't understand, I don't understand. What cash flow? I don't
Let's
understand.
say see 40,000 for the payback period. And then year 2, the cash flow was 20,000. And you got 40,000 a year worth for the payback period. Would you do it like the
If
same way?
what I want you to know is that look at the balance at the end of year 1. What was the figure?
40,000,
What is the cash flow for year 2?
30,000.
So the 40,000 balance owing and the cash flow year 2 30,000. Which one is greater?
The year 2.
The year 1
Hey,
balance is 40,000. Pay attention. Year 1 balance is 40,000. Year two's cash flow is 30,000. Between the year 1 balance, which is owing, which is pending, which is negative, and the
yeah,
year 2 cash flow of 30,000, which one of them is greater?
the one that
Just
is negative.
don't think about the negative. Just look at the figures. Don't think about
The
the negative
40,000.
40,000. So because the 40,000 is greater than the 30,000 in year 2, we would say use your 30,000 to go and pay a portion of what you owe. Are you getting it?
Yeah.
So because the 40,000 there, don't now in absolute terms, I mean, ignore the negative sign. So because the 40,000 is greater than the 30,000, the 40,000 which is owing, which is being owed, or the owing balance is more than the 30,000 cash flow, we would say use your 30,000 to go and pay what you owe, 40,000. So how much will be left? 10,000.
Mm,
So the 10,000 is still owing, or is the month being owed at the end of year 2. So compare with the year 3. What's the year 3?
40,000.
40,000. The 10,000, which is the year 2 balance, is it more or less than the 40,000, which is in the year 3 cash flow?
It's less.
So because the 10,000 balance owing or outstanding is less than the 40,000, we will take the 10,000 in absolute terms and divide it by the 40,000 because the 40,000 is greater than the 10,000 and multiply by 12 months. You cannot do the
Yeah.
same for the 40,000 in year 1 balance and cash flow of 30,000 in year 2. You can't do the same because the 30,000 in year 2 is less than what is being owed, the 40,000 in absolute terms. Do you understand it?
Yeah.
Absolute terms, I mean, if it is negative, treat it like positive. That's what I mean. So the 30,000 in year 2 is less than the 40,000 in year 1, which is being owed. But the year 2 balance is 10,000. And that 10,000 which is being owed is less than the 40,000 which will come to the business. In other words, the cash flow for year 3, which is 40,000, it is greater than the balance the business has to pay, right?
Yeah.
So bring the balance the business has to, which is 10,000, divided by the 40,000 and multiply by 12 months. Meanwhile, in year 1, the balance the business had to pay was 40,000, and the cash flow for year 2 is 30,000. The balance they have to pay is greater than the cash flow. The cash flow is less than the cash flow of 30,000 is less than the 40,000, so you cannot divide it by it. Like
Mhm.
from the payback period perspective. Are you getting it?
Yeah.
Okay, so 10,000 divided by 40,000 times 12 months. How much? What's the figure?
3.
3 months, right? Is it straight away 3 months?
Yeah, three. Just says three.
So it means the payback period did the business use? How many years the business used to be paying all the loans to defray the loans? How many years?
Three.
No. How many years? 2 years. Year one and year two. It's easy to
Oh,
pay
okay.
back fully. Uh-huh. But in
Oh,
year three, it didn't use all the 3 years. It used only 3 months in year
mm,
three because the balance is 10,000 and I'm having 40,000. I can pay the 10,000 and I also have 30,000 as my positive cash flow. Do you understand it?
yeah.
So it means the business will not use the whole year three to pay 10,000. It means that it will use some months in year three to pay off the 10,000 because it is less than the cash
Mm,
flow. But for year one and year two, the amount owing were greater than even the cash flows coming in. Look at the year one. The amount owing was 100,000 for year zero. And then they got 60,000. So they have to go and pay and write the balance on the right. Then year two, as at the end of year one, they have 40,000 they have to go and pay, settle. By year two, what money came in? How much money came in? 30,000. They have to go and pay what they have. They are still owing 10,000. By year three, the money they will receive or the earnings they will make in year three, cash flow, is greater, far greater than the 10,000 which they are owing. So they can pay the 10,000 within year three and still have balance left.
mhm.
Are you good? So we want
Yeah.
to know in year three, how many months will it take the business to pay back the 10,000?
Okay.
Are you getting it? So when
Yeah.
we add, the watch. So in year three, how much we paid in year three?
You bid
In
three
year three, how much money would they pay? How much would the business pay in year three? Amounts the business owes. How much would they pay in year three?
10,000.
10. So watch. The 10,000 here in year three, plus the 30,000 they paid, which couldn't pay all, plus the 60,000 they paid, which couldn't pay all in the year. When we add those three, they should give us 100,000.
Oh, okay.
So in year one, they will pay 60,000, but still they owe. Year two, they will pay 30,000, still they owe. But in year three, they will just take 3 months in year three, pay their 10,000. So that the 10,000, the 30,000, 60,000, all combined will give us the 100,000, which they mean that they will finish paying the money in 2 years, 3 months. Do you understand it?
Mm, yes.
So the payback period is 2 years, 3 months.
Mhm. I get it.
Are you good?
Yeah.
Now solve for plan two. The same approach, plan two. Have you finished writing?
Yeah. So question I.
Okay, so we are done with payback. Let me solve it quickly. So payback period for plants two. You have to practice. So don't wait till exams. And if your exams is beginning shortly. So payback period for plant two. Let me use red. Payback period for plants two. We have year, we have zero, we have one, we have two, we have three. We have cash flow, we have 60,000. What are the cash flows for year plan two? 36, 16, 28.
28.
36. 16.
28.
28,000. Then we have the payback period. 36, 20 will give us 24,000. End of year 0.
8,000.
Year 1. And this one give me less 8,000. I'm going to have 8,000 divided by 28,000 times 12 months. And what do you get? You have 3.4 months. So it means the payback period is, so payback PBP is 2 years, 3.4 months. 2 years, 3.4 months. So now the question is, for the first one, we got 2 years, 3 months. But that is for the plant 1. And plant 2, 2 years, 3.4 months. Now, the question was saying we should comment on each. Okay. The question was we should comment on each. Okay. It says for each of the plants, A, calculate and comment on your findings about the proposed investments. So we will say that, so payback is 2 years, 3.4 months. Payback is 2 years, 3 months. That will be the comment on them. Okay.
Oh.
Okay. Right. So that's it. We are done with the first one. Let's go with the IR. So II says what? Discounted payback period. So it's the same payback period, but then this one has discounted. So you're going to make use of the discount factor. So discounted PBP. Discounted payback period. Discounted payback period. I'm going to use a format where, let me see whether it's going to work. Okay. So I'm going to solve for plant 1. I'll begin with the year. Year 0, year 1, year 2, year 3. Then I'll begin with the cash. I'll continue with the cash flow. What's the cash flow for plant 1? 100,000. Then I have 60,000.
30,000.
Then year 2?
30,000.
Year 3?
40,000.
When we finish, I'll bring a certain question. That one doesn't involve the cash flow. It doesn't involve depreciation. They are just cash flow. So you just continue. You use the cash flow and you continue from where we are.
Yeah.
But this question involved profits and depreciation. So you have to first find the depreciation, add it to the profits, get the cash flow before we continue. But the one I'll bring, it only contains cash flows. So it means if the question gives only cash flow, you go straight, yeah. That's why I decided to solve, because as I solve this, it will cater for that question as well. So discounted payback period, you have the cash flows. How do you discount? When I say you are discounting cash flows, what does it mean?
You are reducing.
So what do you use to reduce it? Good. What do you use to reduce it? The discount factor. You use money, leave the class. You use money to reduce it, leave the class. Pack your bags.
Minus.
You said what?
Minus.
Okay. Leave the class. Pack your things and go and leave the class. So we have cost of capital. What's the cost of capital? 10%. This is representing the discount rates. Okay, I don't have to explain it so much, but let's say that's the discount rate. So the discount factor is at what? 10%. And 10% is the same as what? In decimal fraction terms, it's the same as 0.1. And the discount factor is what? 1 plus R exponent negative n. This is the discount factor I'm going to use. This discount factor will help reduce that 60,000 cash flow, that 30,000 cash flow, that 40,000 cash flow to the present. So the cash flows are like future values because the business is yet to end them. Are you good?
Yes.
Good. So we have 1 plus r exponent to negative n. When I change the r to 0.1, which is a discount factor, exponent negative n, what is n?
N is a cash flow. Hey, N
Good.
is
So for
the
the first
a
year,
year.
what's the first year? Year what? 0, right?
Yeah.
So compute as I've written. Just this. Do it on your calculator.
Okay. Oh. So 1 plus 0.1.
Brackets open. Just type what you see. Bracket open. 1
So I
plus
got
0.1.
1. I got 1.
So you put 1 there. Now change the 0 to 1.
I got 1.1.
Change the 0, the negative 0. Change the 0 to 1.
Oh, it's negative 0.
Yes.
Oh, okay.
So change the 0 to 1. Just change the. So maintain the same thing on the calculator. Don't press on. Then move the arrow, direct it at 0. Change the 0
I
to
got
1. We're talking to year 1.
0.90. 0.91.
No, 909. Leave it in 3 decimal places. The next one is
Oh,
0.87 watts.
0.826.
Okay, 826 rather. The next one is 0.7 watts.
51.
3 decimal places.
So it
Then
should
we said,
always be in 3.
yes. So we said that if you want to find the present value, I'm picking it from this formula. Present value equals what? The future value. That's why when we began, I was explaining them for you to understand this. What is the formula for present value?
Please
Present
don't give
value
us the
equals
formulas during the
no
exam.
formula. Pay attention. No
Oh,
formula.
but the woman says some formulas.
There will not be many.
Oh,
So present value equals future value times what? Discount factor. So the cash flows are like present values. The cash flows are like future values. Then we multiply them by the what? Discount factor before we can get the present value. Do you get it?
yes.
So negative 100,000 cash flow times 1 will give us what? Neg 100,000. Do you understand it?
Yeah.
Hello?
Yeah.
Multiply the next one.
60,000 times 0. And 0.909. That will give
What
us
do we have?
540.
Mm-hmm.
Then 30,000 times 0.82 or 6 or 1.
826.
24780
247.
80.
The next one is what?
Times 0.751. That 30040.
So look at the PV value for year 1. It's 540. Is it 540,000 or 54,000? Year 1. But I'm calculating the thing. Will give me the values. Mm-hmm.
54540.
60,000 times 0.909. What do you have?
54540.
Don't make have to make mistakes. So when you make mistakes, the figures, final values for decision making will change.
Okay.
All right. So you will see that the PV, the present value of the year one, is 54,540. It is less than the cash flow of 60,000. Why? It's because of the discount factor. So the discount factor has reduced it from 60,000 to 54,540. You understand it?
Yeah.
Present value is the value now. Cash flow is the future value, is the value in the future. So year two, 30,000. It has reduced to 24,780 by virtue of the discount factor. Year three, 40,000. It has reduced to the cash flow of 30,040 by virtue of the discount factor. So discount factors always reduce money's future values to the present, making the future value smaller than in the present, like what we are seeing there. 60,000 is a year one cash flow. Discount factor has reduced it to 54,540. So when the discount factor here also multiplies the cash flow, when the discount factor also multiplies the cash flow, we also call it discounted cash flow. That's why we say discounted cash flow methods. Are you getting it? DCF.
Yeah.
So when the discount factor D multiplies the cash flow CF, we have DCF, discounted cash flow. That's why from the beginning we said discounted cash flow methods, meaning all those cash flows we are going to work with, they will be discounted by virtue of the discount factor. Or we can say the cash flow, when they are discounted, we have the present value. So whenever you hear present value in capital budget, it means that discount factor is there. Because without the discount factor, you cannot change the cash flow, which is the future value, to the present. We good?
Yeah.
Pay attention. You do the plan two. I'm doing for plan one. All right, let's continue. Now, after we've gotten the discounted cash flow, we'll now go with the discounted payback period. We'll now come and do the payback. And in the payback, what we were doing when we had the payback period, the way we were subtracting and writing the balances, we repeat the same method here. But this time around, we are not going to base on the cash flow to do that. We're going to base on the discounted cash flow, the PV, to do that.
Okay.
I good.
Yeah.
So year one, what is the figure? Negative
100,000.
100,000 plus 54,540.
That would give us
Don't make a mistake.
okay, negative 100 plus 545 would give us negative 45460.
4,540.
45460.
What's next?
Okay, so negative 100,000 plus 54540 plus 20, 780. Negative 20680.
20.
680.
How come?
206.
Hold on.
Is it 24780 or 24180?
24780.
Yeah.
So how much is that? So what do you have? You said 20 what?
20680.
680. Twice. Okay, 16. Then this will give us hold on. Hold on. That's correct. So what is the next one? What do you do for the next one?
So you make it 20 680 divided by 30040 times
Why?
12.
Why do you make it that way?
That's what it tells me.
I explained because the balance at the end of the second year is less than the cash flow,
Yeah.
the PV in year 3.
Right.
You have to understand. That's what I'm explaining. Not just that's what I said. I need to understand it. Because year 3, the PV for year 3 is 30,000, which is above the balance at the end of year 2, which is 20,000. So 30,000 here, the 30,040 is more than the 20,060. So we just put the smaller one over the bigger one times 12. But look at year 2. Year 2, the cash flow is 24,780. Then the balance was what? 45,460. So it's less than it.
Yeah, so that will give us 8.2. So close 8 months, going to 9 months. There to be 2 years, 8.2 months.
Is it 8.2 or 8.7?
8.26.
So let's say 8.3. So the discounted payback period equals what?
2
2
years.
years, 8.3 months. Now follow the same approach and solve for the plan 2.
Really. A lot though. But I beg.
Lazy student. Lazy students, do my work for me.
Hey, God.
Okay, let's continue.
I. One question though.
So the I hold on. All right, so the I isn't any difficulty. So watch something. Watch. I'm going to do copy and paste. I'm going to do
Okay.
copy and paste of information. Then I'll finish it quickly.
Okay.
So right? What is the I?
So the net present value,
All right,
NPV.
the NPV. I'll begin with the year
Mhm.
0, 1, 2, 3. Between
Yeah.
the computing the plant 1 discounted payback and the plant 2 discounted payback, what is common between both of them?
Welcome again.
What is common between the plant 2 discounted payback and plant 1 discounted payback? What is common? What is
They are
common? What can you
different. Their differentiation factor is common.
discount factor?
It's
Hmm?
common.
So the discount factor is common. Are you getting it?
Yeah.
At what? 10%. So year 0, what is the discount factor? It is 1. Year 1, 0.909. Year 2,
Zero point eight
0.826.
two six.
Year 3,
Zero point
0.751.
seven.
So between plant 1 and plant 2, their discount factors, or the discount factor is the common thing between both. Then I'll write here plant 1. Plant 1, I'll write cash flow and PV. Then I'll write here plant 2, cash flow and PV.
Okay, so now
I
we
get
bring
it.
them together.
Yeah, I'm putting them together.
Okay.
But of exam, I don't have so much time.
Oh,
So what
but
is the cash flow? I'm listening.
yeah, I've seen it. So we can only put them together when they ask for net present value, right?
Yes.
Okay.
So the year is common for each of them. The discount factor is
And
also common for each of them,
yeah,
but the others, they are separate. So what is the cash flow for plan 2? Let's plan 2 is here, so let me write it. Plan 2's cash flow are what? 60,000.
100,000. Plant one
Okay, okay.
first.
Okay, plant 1 first. So let's look at plant 1. Plant
A
1's cash
hundred
flow are what?
thousand.
100,000,
thousand,
60,000, 30,000,
thousand,
40,000.
40,000. One six three
So
four. One
I have
six three
100,000
six
outflow, 60,000
three
inflow, 30,000
40.
inflow, 40,000 inflow. Then what are the PVs? The PVs are already there.
The PV was, where are you? PV or DP? DF.
PV. You see, I've written PV here. Plant one.
Ah, it's PV.
100,000.
Oh,
Then 54,540. 24,780. And what? 30,040. Do you get it?
yeah. PV
In
is
other
also
words,
called what? PV is also called differentiation factor, right?
PV is present value.
And you wrote slash DEF.
DCF.
Okay.
And a DCF is that the discount factor times the cash flow will give you discounted cash flow. Discounted cash flow, DCF.
Okay.
Do you get it?
Yeah.
So I've just copied the discount factor over there.
Yeah.
I'm slowing my time because I want you to understand. But if I'm to solve it, I would have finished sooner than now. So
Okay.
the discount factor is copied here, the cash flow is here, and the PV is here. So I'm just copying and pasting. I am
Mm.
not now going to multiply again because it's already up there.
Yeah, I've already done it.
So plan two, give me the values.
So the
Cash flow,
C cash flow, we have
year
60,000.
zero. 60,000 what?
60,000, negative 60,000. So
Mm-hmm.
into bracket 36,000,
Mm-hmm.
16,000, and
Mm-hmm.
28,000.
Mm-hmm. The PVs.
The PV, we have 60, negative 60,000. And then
Mm-hmm.
36,000, eight, 32724,000.
32724.
Yeah. And then 13216.
Mm-hmm.
And then 21028.
I get
Yes.
it. Now pay
Yeah.
attention. I'll underline the PV. And I write here total PV. So total PV mean I'll add all the PVs. I'll not add the negative. So I'll start from 5, 4, and I'll add to 30 and 40. For plan two, I'll start for 32 and end at 21. I'll add them and write a figure there. So when
Okay.
you add, what do you have? 54, 520, 540, 24, 780. I'm adding all the PVs.
Okay. So 54540 plus 247 what?
2 for 780.
80.
Then 30 and 30,040.
That will give us 10936.
10.
9360. Zero.
Do that for
And
the
then the
next one.
other one,
That one.
32724 plus 13216 plus 21028. That will give us 66968.
66.
968.
Mm-hmm.
Yeah, that's it.
Then you will say less cost of investment. Another name for cost of investment is this cost of investment, this figure. This. The cost of plant. It could mean cost of plant. Here it is plant. So it could be
Yeah.
the cost of the asset. It can be the cost of the asset. We can also say cost of investment. We can also say initial outlay. We can also say initial investment. We can also say capital outlay. So all these words refer to the same thing. They are all synonymous. Are you getting it?
Yeah.
This cost of plant. These are the other words, other names which can be given to it. They are all synonymous. So let me say less cost of, or let me say less initial investment. Did you write what I just took away?
No.
You
So
should
when
write
you're
it.
done, please send me
Oh,
the recording.
have you written it? Cost
I
of
can't.
plant or asset equals cost of investment equals initial outlay equals initial investment equals capital outlay. The variant forms of writing the cost of plant. So when you go and you see a different name, you don't say you don't know. You don't conclude that you don't know. You know, but just that the
So
names
cost
have
of
changed.
plant is equal to
Cost of investment, meaning it's
cost.
the same as cost of investment equals initial outlay equals initial investment equals capital outlay.
Okay, I'm done.
Okay, so you write less initial investment or initial outlay or capital outlay, whichever one it is.
Mhm.
So less initial outlay or capital outlay or initial investment. So for plant one, what is the cost of plant?
That one is 60,000.
Plant one.
109360.
What is the cost of the plant?
The plant was 600,000.
So we less means subtract it. Plant two, what was the cost of the plant?
60,000.
So plant one, what is the difference?
So 109360 minus 100,000. That should give us 9360.
Then what is the initial investment for plant two?
It should give us a negative 6968.
Use the calculator and give me the answer.
A positive 6968.
This figure, what we just wrote, is called the NPV, net present.
Okay.
So net present value means, pay attention. Net, whenever in finance or account you hear anything net, it means that what is the word after the net?
Present
What
value.
word? Present value. It means
Present.
when you hear net present value, the phrase is after the net is present value. When you hear any word or phrase after the net, it means that that word or phrase after the net, which is the present value, something was taken out from it. The balance is called net present value. So when you hear anything net, let's say net exports, it means that exports, something was taken out of it. The balance is called net exports. When you hear net profits, it means that the profit, something was taken out from it. The balance is called net profit. Are you getting it?
Yeah.
So net present value means present value, something was taken out from it. The balance is called net present value. So we are done with I.
Oh wow, that's the fastest move. Let's
Now,
go.
let's go.
So you
Have
can
you
send me the
written?
recording, then I'll write it. I'll listen and write. Does that is that okay?
So I should keep solving it, right?
Yes. Then I'll listen and then rewrite everything.
Okay. So we are going to IRR, which is the IV.
Yeah.
IRR is saying that we want to measure what's the current cost of capital. What's the current cost of capital? The rate. What
The
is the
current
current?
of
What's the
uh
current cost of capital? What we use for the computation?
for which
This.
one? The plant one.
What's the cost of capital?
Plant one is current
See what I've
cost
circled. Look at what I've circled.
10%.
10%.
10%.
So it's 10% is for all of them. The 10% is for both of them.
Okay.
I guess
Yeah.
the 10% cost of capital or the interest rate or discount rate or discounts, yeah, it's for both of them. But when it comes to the IV, the IRR, we have solved the first, we have solved the NPV using the 10%. IRR is saying that adopt, right, another cost of capital, which will give us a positive. And here, with the first NPV we solved, the plant one was positive, right?
Yeah.
And the plant two was also positive, right?
Yes.
But IRR is saying assume another cost of capital, and then choose or take that cost of capital to compute another NPV, right? Compute another NPV. So when you compute the other NPV, you should get about, if the plant one NPV is positive, you should get negative for that new one. The new NPV you are going to solve, you should get negative there. If plant two is positive NPV using 10%, the new NPV you are going to solve using another or a new discount or cost of capital or interest rate, you should have a negative NPV there. Do you understand it?
Yeah.
So when we bring IRR, it means we are going to compute another NPV, the same thing, but another one. Are we good?
Yes.
And here we use the 10% the question gave, but the other one we are going to compute, the new one we're going to compute, we will take our own NPV. Sorry, we will take our own discount rate or cost of capital. So mostly, if this cost of capital is giving us positive figure, then we would say 10%. We would assume, so IV, we will assume that, so IRR, we will bring in another discount factor, another rate. So let's say that rate is B. The first one, the 10% is A. I good. The A was
Yeah.
what? 10%. So let's say this B, let's multiply this 10% times 2. It will give us 20%. So we have 10% times what? 2. Are we good?
Yes.
So we multiply the first 10% which the question gave by 2.
That's two. So that's 20%.
That's 20%.
Mm-hmm.
So you are going to compute the NPV using 20% discount rate or interest rates. You follow the way I solved it here. This just the same format, only that the discount factor will be 20%. It will change. So it means the
Mm-hmm.
0.90 will change, 8.20 will change. So
Oh, okay.
in your case, for you to arrive at this PV for plant one, the new plant one, the cash flows will be the same. The cash flows is going to be the same. So you pick the year one cash flow, multiply by the 0.9, then you get, let me solve it. Let me solve it. You let me solve it. I wanted to give you as an assignment, but let's do it. Year 0, 1, 2, 3. So we're going to have discount factor now. It's going to be what? 20% at 20%, not
20%.
10. And discount factor, we are using 1 plus R exponent negative n. So
20.
20%.
So
Uh-huh.
by 0.2.
Good. Exponent negative. What's the first year?
0.
Every year, 0 is 1. Then you clear the 0, you put 1 there on the calculator. What do you have?
I have um so one
Quick,
um
quick, quick.
mhm. So I have 1.2. Hey,
No, 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 no,
hold
no.
on. Negative 0.833.
Then change it to the 1 to 2. We are
I
moving to
had
year 2.
0.694. Then with
0.4
three,
what?
0.579. 0.579.
All right. Then you bring the cash flow. So now these are the DF. Then you go to plant 1. You come with the cash flow and the PV.
PV.
Plant 2, cash
Cash
flow
flow PV.
and the PV. What's the cash flow for year 1? The plant 1 is 100,000.
60,000,
Mm-hmm.
30,000, 40,000.
So multiply the 60 by the 0.883 to get the
Okay.
PV.
Okay. 60 times 82,000. 0.833. That'll give us 49980.
2, year 2.
0.6694, right?
Yep.
That'll give us 20820.
Year 3.
So we got 0.579 times plus 1,000. That'll give us 23160.
Then we do the same for the cash flow for plant 2. The year
Yeah.
0, the cost is 60,000.
Then we have
Mm-hmm.
32724.
No. I want the cash flow for plant 2. Don't copy anything from the other one. Well, except the
Hey,
cash flow.
36,000. 16,000. And then 28,000.
Mm-hmm. The PV. So multiply
The
here. We are using a
PV.
discount. Hold on. We are using a different discount factor. So multiply the 36,000 by the 0.83. Don't do and copy from the old one. Otherwise, you are wrong.
Okay. So we do it
So
again.
multiply
0
36,000 by
point,
this.
yeah, 0.833 times 36,000. That gave us 29988. We have
Mm-hmm.
0.694 times 16,000. That gave us 11104.
Mm-hmm.
We have 0.579 times 28. 28,000. That gave us 16212.
16.
212.
Then we add. I believe your figures are correct too.
We
Now let's add. Add all the PVs. For plant 1. Plant 1 is P1. Plant 2 is P2.
okay, so so we have wait, is it 49980 plus 20820 plus 23160? That'll give us 9392. 93960.
Then plant 2.
Other one 29988 plus 11104 plus 16212. That gives us 57304.
Then we call this total PV. Less initial investments. This is 100,000. Less. This is 60,000. Less. First one subtracts. What do we have?
So 9. Oh, What happened? Okay. 9,980 minus 100,000.
It's not 93960.
9,960. Oh, okay. Yeah, that would be 939. That would be negative. You know what? Hold on.
I've been holding on for long. My patience has like expired.
Two. So that will give us negative 6040.
Negative 60.
40.
Negative. Put it in a jacket, meaning it's negative. The
Okay.
last one.
57307 minus, well, so this is 60,000.
Yeah.
That will give us negative 2693.
So what is the name for that? The last figures, last row figure. What's the name for that?
That's the NPV.
That's good. Now, the IRR, it has a formula. The formula is watch A, which is the first interest rate or discount rate,
Mhm.
plus the A gave when we use 10%, it gave us an NPV, right?
Yeah.
Let's call that NPVA over that NPVA at the top because we use A. We'll bring it to the denominator also, and we'll subtract the NPVB. We'll subtract the NPVB. So NPVB, bracket close. Then we'll say that the B rate, which is the second one we took, minus the A rate, which is the first one. Are you good?
Mm.
A IRR equals A plus the A gave us an NPV. So we call that A's the 10% gave us an NPV. So we call that 10% NPV as NPVA. Then we'll bring that same NPVA down and we'll take out the NPVB, the second one. Then we'll say into brackets the B NPV, which is the second rate minus the A rate, the first one. Are you good?
Yeah.
All right, let's continue. So let's find the IRR for plant one. What was the initial rate? A is the initial. What was the initial rate we used? The initial cost of capital.
The initial cost of capital was IRR. It was for plus one is 100,000.
Initial cost of capital.
For plants, this one was,
Initial cost of capital doesn't have a plant number. It's for all of them.
oh, that was what? It, 40,
Are you ready?
yeah, I'm here.
Are you here? So the initial cost of capital, watch. When I say rate, discount rate, this is the cost of capital. You are not writing. That's why you are not paying attention. Cost of
Oh,
capital is
10%.
10%. So the original, I've written it here. Here. Can't you see it? A is 10%.
Yeah.
So A is 10%. Write the 10% if you plus. When we use 10% for A, what NPV did it give us for the plant one? So when we use that for 10%, this is the first one. This was the NPV for plant one. Is that correct?
Okay.
Is that correct?
Yeah.
When we use 10%, this was the NPV for plant one, 9360. I was going to ask you to do the next one, but the way you say you don't want to do it. Then the second in the formula, numerator, the first value is also NPV. So we say 9360 minus, what is the NPVB? The NPVB is the new rate, right? When we use the 20%, what NPV did we arrive at? We arrive at what? Negative 6040. So already in the formula, there is a negative. I repeated it here. Then I'll bring another negative because this one is negative. Negative what? 6040. What is this B? What is B?
20.
So 20% minus what is A?
10%.
10%. I wanted you to, okay, you solve the IR for me, though you are not writing. So it will be equal to 10% plus 9360 over. So add, when two negatives meet, what do they become?
Positive.
So you're going to 9360 plus 6040 times 20% minus 10%. What do we have?
0.1, 0.2.
20, just make it 20 minus 10. Don't bring the percentage.
80
I get it.
minus.
20 minus 10. When, watch. When you are adding 4x plus 5x on your calculator, how do you add it?
5, 4 plus 5.
Then what do you have?
That's 9x.
Is this the final answer? 9x. It's the same thing. So 20% minus 10%. Just add the 20 and 10. You bring the
30x.
percentage. Do you understand it?
Yeah.
20% minus 10%. Just add, subtract the 10 from the 20. When you find your final answer, they bring the percentage.
Okay.
So on your calculator, don't bring the percentage. So just subtract the coefficients. The one you finish, you bring the percentage. So the 93 on your calculator, compute 93,
15400.
are you listening to me?
15400.
On your calculator, find 9360 over 9360 plus 6040. What do you have?
Oh, I got 0.60, 0.61.
Give me 4 decimal places. 0.61.
0.608. 0.6078.
Hold on. Times
0.6.
what? Times 10%.
Yeah.
So 10% plus, now multiply all these. Don't bring the percentage.
Zero point 160. Wait, it's actually bring the
So don't bring
percentage.
the percentage.
So, want to give me a different figure? Okay, so I got
Be quick.
16.078.
Did you add everything?
Yeah, but I
Okay.
didn't bring the percentage.
And when you finish, then bring the percentage. 16 point what?
0.78.
Percent, right?
Oh, okay.
Which is approximately 16.1%.
But when I brought the percentage, I didn't get that. I got something like 0 point
Oh,
something.
don't bring the percentage. I've told you, don't bring it. Do you get it?
Okay. Yeah.
If you change it to decimal fraction from the beginning, at the end, where you got the 16, you'll be having 0. You'll be having 0.16078. Then you multiply it by 100%, you get 16.07. So this is if you don't bring the percent, if you don't want to change it from 10% to 0.1, 20% to 0.2, you can write it this way. But when you are multiplying on a calculator, don't include a percentage sign.
Oh, okay.
Don't include it. At the end, when you finish and everything, then bring a percentage sign. That's why I gave you an example. When you are multiplying, when you are adding 5x to 4x on your calculator, do you compute 4x plus 5x on your calculator? No, you just add a coefficient. Then when you get the coefficients correct, you just repeat the variable.
Okay.
So you have to practice, otherwise you forget it. So based
Oh,
on this, solve IRR for plan 2.
we are now on IRR on lectures. The woman is now teaching us that. Oh no, she's not.
Solve
She's not going to profitability index.
solve IRR for plant 2.
Oh, this was just for
Right?
plant one.
It's formula based. Just look at the formula and plug in the
Yeah.
values. That's all.
So,
Good.
yeah.
So just look at what I just did and do it for me.
A plus NPVA. Oh, Mr. Manuel, why do you know that? Why,
Hold on.
why,
I want to
why, why, why,
hold on.
why, why?
IRR for plant 2. The same formula. So yeah, let me use the 10% you wanted. Let me use the percentage. So 10% gives us 0.1. Then you compare, you choose your better option. Plus, what is the NPVA for plants? For plants, when
Five
10% was used
seven
for plant 2.
57307.
Hey, it's wrong.
Hey.
There's
Hmm.
an NPVA for plants 2. Look at the NPVA for plants 2. 6968.
So why did I get a 5 from?
Go and ask your grandfather.
Serious. So how did I? Hey.
6968
Mhm.
over 6968 minus, in the formula, there's already a negative sign. So just minus.
Mr. Man, are you recording?
Why?
Just so that I can write it after.
Are you following? You made a mistake. Are you following?
Yeah.
And this is the NPV B for plant 2. This for plant 2. I've seen your mistake. You went to record a total PV. This is what you came
Oh,
and
this is where I
record.
got it from. Yeah.
You have to write the NPV here. So
MPV.
2693. This is for 20%. Go and pick the 10% NPV. Then you pick the 20% NPV. This is negative. So 2693. So minus 2693. Then B is 0.2. A is 0.1. So we're going to have 0.1 plus. So change, we're going to have 6968 over 6968 plus 2693. Then give us what? 0.1. So change the fractional value. So 0.1 plus, yes, what do you have? 6968 over 698.26 plus 2693. What do you have?
I should go straight and answer it.
Give me the value. Give me the value. 6968 over
There's
6968 divided by 6968 plus 2693.
plus 2893. Oh, hey. That give us
Quick.
0.7066.
0.7066.
0.7066.
0.7066. Multiply by what? 0.1. All together, what do we have?
That will give us 0.17066.
0.17.
066.
Then you multiply this by 100%, which will give us 17.0 or 70.1%.
17.066.
And you make it approximate. So
17.
17.1%. So 17.066%. Approximately 17.1%. Are you good?
Yes, please.
You must always check the figures. So that's it. So always, with all the work we did, the first one, the payback, let me go back a bit. The payback period, where is it? The payback period for plant one. This one, we got 2 years. The payback period was 2 years, 3 months, right?
Yeah.
And this one, plant two was 2 years, 3.4 months. So what we say is that if, assuming the question were like, based on the payback period, we should recommend which project should be undertaken. We would say that the business should undertake or the business should purchase plant one because it has a lower payback period. You want to pay back a loan. Are you getting it? So in terms of if you were to recommend, we would say the business should purchase plant one because it has a lower payback period of what? 2 years, 3 months. Meanwhile, that of plant two is what? 2 years, 3.4 months. Assuming the question asked that based on the payback period, we should recommend what management should do. Are you good?
Yeah.
But it didn't ask that. I said we should just comment it. The same with discounted payback.
Okay.
The payback, it is 2 years, 8.3 months. And the one you saw was 2 years, 8 months, right?
Yeah.
So for the discounted payback, plan two would have been better off. Then NPV, we'll choose if they are all positive, we choose the higher. So plant one NPV was 9,360. Plant two NPV was 6,968. So the higher is plant one. So we'll go for plant one. Do you get it?
Yeah.
That is, if we were to recommend based on what we are solving, then that's what it's going to be. Then we got here with the IRR. The first one was 16.1. The second one was what? 17.1%. Okay. The last two, let's finish it quickly. We have V. We have what? Profitability index, PI. So it is the total PV over initial investments. Total PV over what? Initial investment. What is the total PV? So for PI, profitability index for plant one, what is the total PV? The original one with the 10%, now not with the 20%, with the 10%, what was the total PV?
The total, hold on. The total PV was 28.
Wait, watch. Oh, it's on the screen. You're not looking at it. The
Uh,
total PV for plant one, total PV, Sigma PV. Sigma means summation of PVs.
that's 90.
109,
Hey,
109,360. I'm
360.
not talking about the net PV. I said total PV.
That'll be
So 109,360. So for plant one, 109,360. And what is the initial investment for plant one? 100,000. Are you good?
yeah.
So what will be the PI?
So 100 and okay, you've gotten
What is it?
106.
360. Is it 106 or 109?
No, I'm not doing it.
And it's
So
109.
there is six.
It's 109.
Uh,
109,360.
zero over 100. That'll give us 1.0936. 1.0
Just leave it in two decimal places.
1.09.
Then we go to profitability index for plants two. Yeah. What is the total present value for plants two? Total present value. What is
We
it?
had 66968. And the other one was over 60,000. That'll give us 1.11.
So you choose the higher.
That's 1.11.
Yeah. So we are done. We are done with the profitability index. The last one, rules. Anti-rules. Rules. So rules. Rules says return on, the return is a PBIT. It's on the capital employed or PBIT over initial investments. Are you getting it?
Yeah.
So what is the rules for plant one? So it's PBIT, and the PBIT values, watch, they are here. The PBIT means profit before interest and tax. And these figures here, they are all profits figures before interest, before tax. For plant one and plant two, they are all, that's I said, annual profits. This, we have what is called PBITDA. PBITDA, right? Profit before interest, taxation, depreciation, and amortization. So amortization is for intangible assets. Assets you cannot touch, but you cannot touch or feel. Then we have depreciation. Depreciation is for tangible assets. Okay. So from this pivot, there is profit, but the profit means that the profit we've arrived at, we are here to take amortization, we are here to take depreciation before we come to the PBIT. So in this question, there is no amortization, but was there depreciation in this question?
Yeah.
Yeah. So this depreciation, are you getting it? This depreciation. So this profit, the profit figures we have on the board, on the screen, do they include depreciation figures?
No.
Good. So it means it is pivot. It is not pivot that. Are you getting it?
Yeah.
So that's what we are going to use here. So it says pivot. We will pick, so for plant one, we will pick 29,000, which is positive. Then we'll make it minus 1,000, which is negative, plus 2,000, which is positive. 7,000 is not a profit, so we will not include it.
We're not including
What's the initial investment for plant one?
100,000.
Then multiply all by 100%.
Oh,
What do we have?
wow. Minus 100,000. Wow. 2,000. What about 100,000? That give us 0.3.
Times 100%.
Hey, that will give us 0.3.
Times 100. I said whenever I multiply, don't bring the percentage. Don't bring the percentage on the calculator.
30. Anytime I'm solving any of these questions.
Any mathematics, don't bring the percentage. So 30, then you bring the percent. You bring the percent. See, you see, percent means percent. It means over 100, 100. So if you say 100%, it means the calculator would take it as 100 over 100 if you bring the percentage. Are you getting it? So
Yeah.
100, then you say percent. Percent means over 100. So it will be 100 over 100. And the final answer will give you 1.
Mhm.
Do you get it?
Yeah.
So whatever figure you divide the 29,000, I know you got 30,000 there. So 30,000 divided by 100,000 is 0.3. So 0.3 times 1 is to give you 0.3. Therefore, don't bring the percentage sign. When you finish the final answer, then you bring the percentage sign.
Okay.
Are you getting it?
Yeah.
If every figure you want to multiply, let's say 5, you want to multiply 0.5. You want to multiply 0.5 times 100. If you make it 0.5 times 100, though we know it's percentage, all right, but don't bring the percentage sign. It will give you 50%, which is correct. But if you make it 0.5 on the calculator, you make it 0.5 times 100%. The calculator will treat it like this. It will treat it like 0.5 times 100 over 100 because percent means over 100.
Oh, okay.
So 100 cancel 100. What do we have? 1. So you're going to have 0.5 times 1. So the calculator will still give you 0.5 because we brought the percentage. Are you getting it?
Yeah.
So when you are computing on the calculator, if you want to change to percentage, don't bring the percentage on the calculator. Just
Mhm.
multiply by 100. But your final answer, you bring the percentage sign. The same way I told you, you are multiplying, let's say, 4 times 5x. Then on the calculator, you multiply the 4. Then you say times 5, and you bring the x. Are you getting it?
Yeah.
You don't do that on your calculator. You just say 4 times 5 is what? 20. Then you bring the x, right? On your calculator, you don't display the x on your calculator. By your final answer, you bring your x to the final answer. The same way the percentage sign. Otherwise, your answer might be correct, but because you didn't bring a percentage of something, you might be marked wrong. So this is the rules. Now you do the these are rules for plant one. You do the rules for plant two. The
I
higher
got 33.3333.
33.333 what percent
Mm-hmm.
because you multiply by 100%, so it should be percent. Don't just say 33.333%. You have to practice it so that you can remember.
Yeah, this one here.
You have to practice it. We don't have time.
I read.
Now,
Okay.
so we are done. The last one. State which, if any, of the two investment projects your company director should accept and why. State which, if any, of the two investment projects your company director should accept and why. From your answer B above, right? So, which of the two investments should the company accept? They should accept projects. They should accept plants. Which one is it? Which one had a higher NPV? The first NPV, which one had a, okay. The NPV for the one was 9360. So the business should accept the NPV. The first
Yes,
plant one.
plant one.
So state which any of the two investment projects your company director should accept and why. The company should accept NPV plant one because it had a higher NPV of 9,360 above plant two's NPV of 6,968. So when we use multiple investments, when we use multiple cash flow methods, or when we use multiple capital budgeting methods, the one which is mostly deemed to be a determinant of whether or not, or a determinant of the acceptability of a project is the NPV. Are you getting it? The
Yeah.
NPV tells whether the business is going to be profitable or it's not going to be profitable. So, of all the I to VI, the ones outstanding and key investment method needed to determine which project should be accepted or rejected is the NPV. So the B says, state which any of the two investment projects your company director should accept and why. The company should accept investment project of plant one because it had a higher NPV above the plant two. So both plant one and plant two from the left, they all had higher NPVs. They all had positive NPVs, but then plant one's NPV was higher. So we choose that one. From your answer B above, discuss the reasons why the NPV method of investment appraisal should be preferred. Are you getting it? So it's the NPV which can be used to determine. And from the following sentence, it says, from your answer B above, discuss the reasons why the NPV method of the investment appraisal should be preferred to other IRR. To other IRR. So the NPV would take into factor, let's say, the time value of money. IRR also does same, but the NPV is more preferred because the NPV is more focused on. NPV is more focused on what's the name? The profitability. But IRR is focused on discount factor, like the cost of capital. I getting it.
Yeah.
So look at the IRR. Look at the IRR value. This is 16.1, which is quite lower. And we have 17.1 here, the one we just saw, which is quite higher. So for that, the B, you can you can research online, read from the manual, and get more reasons or justifications to why NPV method is more preferred to the IRR. Are you okay?
Yeah.
All right. So we are done. Any question?
No, please. If I have any question, I'll let you.
Okay,
Yeah,
that's fine.
thank you. Okay. Mr. Manuel.